Hi traders and welcome to this Pepperstone presentation on risk management, the most important piece of the puzzle for all traders and investors to become successful. In this lesson, we are going to learn why position sizing is imperative to the correct risk management. We're going to learn how stop-loss orders help traders manage risk. We're going to learn about what diversification is and why it is so important to traders in terms of risk. And we're going to learn about using appropriate risk-reward ratios to keep management in check. Risk management is crucial for traders as it helps protect capital and minimise losses. It ensures controlled exposure to market volatility, allowing traders and investors to stay in the game, adapting to changing conditions, and maximise long-term profitability while safeguarding against catastrophic financial setbacks. Let's start with position sizing. Position sizing is a critical component of effective risk management when trading financial markets. It involves determining the amount of capital to allocate to a particular trade or investment. Proper position sizing is important for several reasons. Firstly, capital preservation. By allocating an appropriate portion of your capital to each trade, you minimise the risk of significant losses that could deplete your entire investment portfolio. Then we have diversification. Position sizing allows for diversification, spreading your capital across various assets or trades, reducing the impact of a single bad trade on your overall portfolio. It also helps with risk mitigation. Proper position sizing helps control the potential downside risk by limiting the exposure to any one asset in the market. This ensures that a series of losing trades doesn't lead to catastrophic losses. Then we have risk-reward balance. Position sizing ensures that your potential rewards are equal with the risks that you are taking, helping to maintain a favourable risk-reward ratio in your trading or investment strategy. And then we have emotional discipline. Correct position sizing promotes discipline and reduces emotional stress, as you are less likely to make impulsive decisions when your positions are appropriately sized. The next important factor is stop-loss orders. Stop-loss orders are crucial risk management tools when trading and investing. They work by automatically selling a security or currency when its price reaches a predetermined level, thereby limiting potential losses. By setting a stop-loss order, traders and investors establish a predefined exit point, which can protect their capital and prevent emotionally driven decisions. This risk management technique is effective for several reasons. First, it helps to mitigate the impact of unexpected market fluctuations, reducing the risk of significant losses. Secondly, it enforces discipline in trading, ensuring that investors stick to their predefined risk tolerance. And finally, stop-loss orders provide peace of mind by allowing traders to participate in the markets without the constant need for monitoring. Overall, stop-loss orders are an essential tool for managing risk by providing a systematic and objective approach to protecting investments and trades, promoting responsible trading practices, and minimising the impact of market volatility. Next, we'll look at diversification. Diversification is crucial to managing risk because it involves spreading investments across a variety of asset classes, industries, or geographical regions. By doing so, traders and investors can reduce their exposure to risk associated with individual assets. A great risk management approach is to risk only a portion of your account per trade, say 1%. This means closing positions that lose more than 1% of your entire starting account balance. In theory, this would work fine if the trades that you have been placing are appropriately diversified. As an example, if you have a portfolio valued at $100,000, you would risk $1,000 per trade. If your risk is spread across 10 different positions, the most that you could stand to lose if all those positions turned against you is $10,000. The example that we can see here on the screen shows a trader with a trading portfolio risking only 1% per trade, with a bias to a weakening US dollar. They have taken long positions in the Euro USD, Aussie USD, and Pound USD, and short positions in the USD Yen, USD CAD, and USD Swissy. Now, although this trade has only risked 1% per trade, if their bias on a weakening US dollar is wrong, all of these trades are likely to fail because there is no diversification in other sectors. This could mean that the trader could lose 6% of their portfolio value in an otherwise normal market with a strong US dollar outcome. Next, we'll look at risk-reward ratios. Risk-reward ratios are crucial in decision-making across various aspects of life, but particularly in finance and investment. These ratios help individuals assess and manage the trade-off between potential returns and the associated risks. Here's why they are important. Informed decision-making. Risk-reward ratios provide a quantitative framework for evaluating the potential gains and losses in any particular trade, aiding informed decision-making. They help traders assess the attractiveness of an opportunity and its alignment with their risk tolerance. Risk mitigation. A well-balanced risk-reward ratio allows for risk mitigation. By carefully weighing potential rewards against associated risks, traders can implement risk management strategies such as diversification to reduce the impact of adverse outcomes. Then we have goal alignment. Understanding risk-reward ratios helps align traders with their strategies and specific goals. Different goals may require different risk levels, and these ratios assist in finding the right balance. Then we have long-term sustainability. Maintaining a favourable risk-reward ratio promotes long-term trading sustainability. By avoiding overly risky positions, traders and investors are more likely to withstand adverse market downturns and fluctuations. Having a clear risk-reward assessment provides psychological comfort, reducing emotional decision-making and impulsive behaviour. Risk-reward ratios are essential tools for evaluating opportunities, making rational choices, and achieving trading objectives while managing and mitigating potential risks. They are a fundamental component of prudent decision-making for all traders and investors. In this lesson, we've learned why position sizing is imperative to the correct risk management. We've learned how stop-loss orders help traders manage risk. We have learnt what diversification is and why it is so important to traders in terms of risk. And we learnt about using the appropriate risk-reward ratios to keep risk management in check.